Hey guys, how's it going? I'm Zack Hatcher and you're here on Zack's Corner. Nice to have you guys. So we're here at Linthicum, Maryland at one of our beautiful... Hey guys, how's it going? I'm Zack Hatcher. Hey, what's up? What's going on? Welcome back to Zack's Corner, guys. Thank you so much for stopping by. I appreciate you so much. Thank you for the love, the support, the likes, comments, subscribe, shares, guys. It means the world to me. Thank you so much. I appreciate you, man. We're just looking to provide great content and information to you guys. That's what we're here for. So today we're going to talk about something really cool. We're going to talk about interest rates. Interest rate is the percentage of principal charged by the lender for the use of its money. And of course the principal is the amount of money that's lent, right? So so I'm a real estate agent and I'm a real estate investor, right? So in reference to the mortgage world, when you're dealing with, you're an individual who is looking to get their primary residence, whether it's first, second, third, fourth, fifth, or even using a bank or a mortgage lender to refinance or do a 203K loan, which is a rehab loan, in order to rehab a property, those interest rates are really volatile in that world. Now they're really low right now, lower than they've been in some time, but they're still volatile. And what do I mean by that? So what I mean is in February, let's say in February you sign up with your mortgage lender, you sign up with your realtor, and you're ready to purchase your home. So the closings are going to happen for some time, maybe a month, 2-3 months. So let's say 3 months later in June, May or June, you actually close on your home. So whatever interest rate your loan officer quoted you in the beginning in February may have skewed 0.1, 0.2, or 0.3 or 0.4% up or down in that time frame. So by the time you close on the home, you may have a slightly different rate than what you were initially quoted. So guys, that's what I mean by the volatility of the interest rates. Now, if you're in the investment field and you're looking for financing like hard money lenders or private money lenders, those guys and gals and companies have flat interest rates. So individuals who have higher credit scores obviously are more privy to the better interest rates and have the opportunity to get pre-qualified for more money. So that's why credit is king, guys. I always say that to everyone nowadays. And we'll talk about credit on a future episode of Zack's Corner, but credit is so important, guys. I definitely want you guys to know that. So let's talk about fixed and variable interest rates. A fixed interest rate or fixed rate is a rate that is set for the life of the loan. So if you have a 30-year fixed rate mortgage on your mortgage, that means that for the entirety of that 30-year, the life of that 30-year loan, your interest rate will stay the same, which is obviously really good, right? You go through trials and tribulations, ups and downs. At least you know one part of your payments based on your home is set in stone. And variable is pretty self-explanatory. It varies. A variable rate will fluctuate during the life of the loan, and it will based on market index, inflation, or another interest rate. So things that are on the outside, on the exterior of your home and your situation, like the stock market, the real estate market, inflation, the economy, all of that stuff can play a role in why your interest rate may go up or down. So keep in mind the difference between fixed and variable interest rates. All right, so let's talk about exactly how to break down what your monthly interest payments would be on a mortgage, right? So when you get a mortgage, when you are paying your payments for the entirety of that 30-year, or maybe you got a 15-year mortgage, those monthly payments are going to be broken down into what's called PITI, okay? P-I-T-I. So the P, it stands for principal. Principal is the amount that was borrowed. So if you have a $200,000 mortgage loan, if you were lended $200,000, your principal will be $200,000. The first I is your interest. Obviously, that's what we're talking about today, right? Your interest rates. T is your taxes. So your taxes for your home is tied up in your monthly payments, which is good. So, and then after your 15 or 30 year mortgage is up, your taxes, and you own free and clear, your taxes will be paid at the end of the year every year. So please don't forget that if you own free and clear, because you will go into tax auction after 2 years and someone can buy your home for the amount of the taxes that you owe and foreclose and kick you out. But we'll speak on that in another episode. All right, so we got principal, interest, taxes, and the last I is insurance. All right, we all need insurance. You need life insurance on your life. You need house insurance on your house. So that's important, right? So this is what your monthly mortgage payments will consist of. Pity, principal, interest, taxes, and insurance. Okay, so let's break down an example of how you can break down what your monthly interest payments would be. Okay, so let's say you've got 3.99 interest rate on a $275,000 loan. Okay, so in order to crunch this number, you have to turn this into a decimal. All right, so you have to multiply this times 100. I'm sorry, you have to divide this times 100. And when you do that, you'll get 0.0399, right? So we want to do monthly, right? We want to find out what out of our pity, right? Out of our principal, interest, taxes, insurance, out of our entire monthly mortgage, how much of that is interest payments? So if that is, so that means that we have to divide this number by 12 months, because this is an annual number. We have to divide this by 12 months. And that will give us 0.003325. Okay? So the next step, in order to get the monthly interest payment amount, we have to multiply this number by that 275,000 that we were actually lending on, right? So let's wipe all of this away. Remember, that number is, we got it right here, 0.003325. And that equals $914.37 a monthly interest payment. Okay? So, and I'm not a mortgage lender, but out of all the business I've done in my 5 years of being in the real estate game, $275,000 mortgage loan, depending on, because everyone's situation is different, your mortgage could be anywhere between $1,800 to $2,000, depending on it. Now that's just a roundabout. And out of that, $914 would be your monthly interest payment if you had this as your interest rate. Okay? So guys, thank you so much. I appreciate you so much for stopping by. I hope you learned something today. Of course, once again, please like, comment, subscribe, share. Put a comment in the comment section below if there's anything specific you'd like for me to talk about. I just want to give good value and content to everyone. And you know how we do it, baby. This is Zack's Corner. See you next time. We out.